Hello everyone, Stock Market Daily. Thank you for joining me today. It is June 15th, 2023. As always, the disclaimer is this is not financial advice. Please don't copy my trading strategies because you will lose money. This is only for educational purposes. And today is a good video to show you exactly why this is only for educational purposes because I am losing a ton of money on my call positions. But first, let's take a look at the chart. Actually, pre-market, we were down and we did have a little bit of a gap up here. You wouldn't even notice it because we instantly closed the gap and pretty much rocketed up from here, closing the gap, hitting this previous level of resistance and breaking through the 4,400 level like it was nothing. I mean, there was a little bit of like hesitation here and broke it, never even looked back, never came back, touched it. No big sell off except maybe a little couple of red candles here, but never came back to it really and took off from there. The only kind of red candles we did see is right here towards the end of the day with a little bit of pressure, probably people taking profits as most of the stocks were hitting their 52-week highs and also all-time highs, for example, Microsoft, Apple, and others. So we are at a 52-week high. The all-time high for the S&P 500 is actually 4,800. So we're about less than 400 points away. It might be 4,800 and something, but we're about 400 points away from that only. So just something to keep in mind. So let's take a look at the trades today. There wasn't many. The only thing I could deploy today was my puts. I did enter one at the 43.20 and one at 43.35. I did try to put one at 43.40, and I believe this one was like 300 something dollars when I tried to put it on. However, I was being cautious. Yesterday was the FOMC meeting, so we were trading lower pre-market with a little bit of a gap down. I really did assume that today we're going to have either a little bit of a sell-off at least or some kind of a pause on the run that we had. However, so I was lucky enough actually these two filled, but this one did not fill because, like I said, we started running pretty much right away. So that is it for the actual trades. The rest of the call positions, they were rolled. I believe there was 4 calls that were trapped in the money, deep in the money, and they were rolled into tomorrow. Now tomorrow I do have the 4 calls, which is right here, and the 2 that were previously open, probably from a while ago. So I don't remember even how long ago this was from. So I do have quite a bit. And this one is my most losing position right here at the 42.12. I did want to address one of the questions that I got in regarding what I mentioned yesterday about the splitting the losing positions into several options, which will help raise the strike price. And I was actually thinking that I was going to do this today. And the way this works is basically this. So I have a bunch here, right? I have, what is this? 1, 2, 3, plus 3, 6 positions that are deep in the money. Now, what I'm going to do is I'm going to ignore the rest of these. I'm going to go for the one that is the deepest in the money, the one that's losing the most at this time. And it's this one at 42.12. So the plan today was when this one, and by the way, I rolled all of these, not higher in strike price. I rolled them just one day and I collected like $70 or $60 premium on each one of these rolls, but the strike price remained the same. Obviously, there's just not enough premium to roll them into, roll one day only and also collect, and also increase the strike price. And I'm not taking a loss, so I'm not actually buying the strike. I'm simply collecting the premium. Okay, so now that we got that out of the way, So imagine this is today and the stock market opens and you see that you have this position that is 42.15. So what I was planning on, and this is only and pretty much works only really well if that's the important part, is if the market is going to be trending towards the direction that you are losing. So these are call positions, I would only split this position into two if the market is trending down. Now the opposite side, if I am deep in the money on the put side, okay, if I'm on the put side and I want to split this position right here, let's say, I would only do that if the market is trending up because I wanted to go favorably in my position. So originally I thought that the market's going to actually go down, or at least probably, slightly go down and go down more on Friday. We had a pretty significant run. We had FOMC. People are still digesting what Powell said. And I started kind of going through the steps of trying to break this into two options instead of one. You can also break it into three options, four options, but the math doesn't really work out that well when you start doing into three options or four options in some of these positions. So basically, you take so this one's really easy. So this one is worth right now 200. So you simply take this position, you buy it back for 200, and you sell it back for 100. Okay, so you sell two of them for 100. So that would bring you back up to, let's ignore this. This is 100 on the bid. Let's ignore the ask. So let's say this is 100. That would bring you up to 43.15 strike price, right? You'll have two options here at 43.15. A much better position to be in on the strike price than it is, right here, 42.15. So the only downside, obviously, is that you are now putting yourself to a little bit of more. You're opening up more. The word I'm looking for is you're going to be spending more money on the actual spread because you have two positions open now, and you're now going to have to worry about two of those positions instead of one. And if the market's going against you, that's going to actually work out against you as well. So now what happened was, obviously the market went up, and this became something that I wasn't going to do then today. I only want to do this on the market is going down, like I said before. Had I done this, and I did I was going through the steps, and when I was originally in the morning, when I was originally going to do this, split it in half, my strike price would have got me to 42.90. So I would have had two options here at 42.90. Okay. But since the market continued to go up, I avoided it and I ended up not doing it. But now that I waited until tomorrow, let's say tomorrow we open up at the same strike, at the same price at 44.25. So if we open up at 44.25 and I see that the market is now starting to go down because we had a nice bull run, then as you could see, as I told you before, if we take this right now, split it into two, at 100, I'm at 43.15. So there's a big difference between 43.15 and 42.90, right? And that just simply works because of the math. If you take this position split in half and you are way more deeper in the money, then the strike price is going to go up. So that's why you want to work with the position that is losing the most at first. Now, the other thing I was going to do today was Some of these options, I rolled them into Friday from Thursday, today, Thursday, into Friday. And the other one I was going to roll into next week, but by rolling into next week, I was going to, and this was the 4280. It was one that is losing the most. And when I rolled it into next week, I was going to increase the strike price. However, that didn't work out because we ran up too high and too fast. But even so, and that shouldn't scare you, and it doesn't scare me rolling into next week or the week after, or even 3 weeks, or whatever it is that needs to be done. I should not be scared. There should not be something like, oh, well, it's so much time, because you can always take the, let's say you roll it into, July 3rd. Okay, you can always take this position that you rolled into July 3rd, and let's say the market is crashing tomorrow, and you see the opportunity to get out of the position, or now that there's more extrinsic value here, you can always take the option from July 3rd, buy it back, and sell the one for the day that you want it to be. So let's say if we're crashing today, but it's possible that we're crashing today, but we're going to bounce back up on July 3rd, or by July 3rd, we're going to come back to the 4,300 level. So you can always go back, you can always backtrack. And I have done that before, and I have done it, not on purpose sometimes. Sometimes I've rolled my position by complete accident, my fat finger the date, or I miss, I just did something wrong, and I ended up with rolling it into the time frame that I didn't want it to be, and I ended up, buying it back and rolling it back to the correct time frame, the correct date. And a lot of those times, that trade ended up being actually more profitable. My mistake actually turned out to be making a little bit of money trying to correct my mistake. So don't be afraid to think outside the box. If you're sitting here and if you're in this kind of position saying, oh my God, I'm deep in the money, I have this big losing position, there are ways that you can potentially finesse the situation and basically, get out of it. Doesn't always have to be as easy as, oh, okay, well, this one is losing, I'm just going to take it and roll it into, next week and a higher strike price. There's other ways you could think about it. If you think about it, you could become creative and think of ways that you could do to get yourself out of this position at a faster time. For now, I'm not doing any of those things because for the past, I think they said in the news, for the past 6 days, we have been doing nothing but going straight up on the S&P 500, which is pretty much a record for the last 2 or 3 years or something like that. So there's going to be a day where we're going to cool off and pause the rally, and we're going to possibly sell off a little bit. And maybe on those days will be doing some of these kind of creative solutions to get myself out of these. But for right now, and even if I don't, it still doesn't matter, because here on the SPX, you're not going to get assigned early. So there's really nothing to worry about. It's not like the market maker or anybody else is going to assign you to this position. As long as at 4 o'clock, you don't have this on your screen, you have it at some other date, you're not taking a loss. And even if you did get assigned, if you accidentally left this position and you forgot about it, or you just didn't have time to trade, you know what? It's very simple. The market opens again next day. You simply open the same position next day and you collect that premium. That's all there is to it. So there's really nothing to be worried about. There's nothing to be freaked out about. And, the only bad thing about this is, number one, as we are trending higher, the premium is harder. There's less premium to collect on these options that are outside They're not in the money, obviously. And when your options are trapped like this, you're not able to trade as much and you're just missing out on the profit. So, um, and even though with that, like I said, I did collect a little bit here and there, 80, 70, 75, 90, not a lot, but still, I mean, on a daily basis, it's still making money. Definitely not as much as before, but we had a really good couple of months before, and still making money. That's the whole point, and eventually you'll get out of it. All right, guys, tomorrow's Friday, options expiration. We do have consumer sentiment and two Fed speakers. So it'll be an interesting day. We'll see how the market reacts and how we act overall with the actual, record breaking amount of updates for the S&P. Will be interesting to see how everything develops. Okay, thanks. We'll see you tomorrow. Bye bye.